Hello friends, good morning to all of you, and this video we are going to cover the chapter number 10 from the module B of the ABF. So already the chapter number 9 we have covered and we have already completed it, and this is chapter number 10, which is related to capital budgeting for the international project investment decisions. So do confirm the audio video quality at the earliest so that we can proceed. And if you want to get the complete CIIB course, you can simply be downloading the application from here. Link is available iibf.info/app, or you can simply be WhatsApping me, writing CAIB to the number 83609 I'll be sharing you the details. So it's about the chapter number 10, which is related to capital budgeting for basically international decision making for the capital investment project investment purposes, right? So first thing first, it's about, like, it's given like Indian company. Here we are having an Indian company which is basically having the equity shares, and those equity shares are placed with whom? Those equity shares are placed with the custodian. Now, when we're talking about the custodian or the domestic custodian, what is the main role of the domestic custodian? What is the role of it? See, the first thing is that basically the custodian is going to hold the underlying shares. So whatsoever the shares of the underlying company, like the Indian company, let's say ABC Indian company is here. So the shares of the Indian company will be held with the domestic custodian here. And further, these shares are handed over to the domestic custodian over here in India, and it basically safe keep the institution. It basically safe keep those shares, right? So that's the role of the domestic custodian. Now there is a custodian agreement between the overseas depository and the further domestic custodian. Like, a custodian agreement will be signed between these two parties, and this agreement basically governs the custody and the handling of shares. And there is a depository agreement, right, related to the same. And further, we are having the overseas investory also. So one is related to custodian agreement, and the other one is related to depository agreement. So custodian agreement is between the domestic custodian and the overseas depository. So here we are having the two parties, domestic custodian and further the overseas depository. And depository agreement is basically agreement between the Indian company and overseas depository. Like, it will be authorizing the overseas depository. It will be authorizing whom? It will be authorizing the overseas depository over here. Overseas depository over here, right? To issue the depository receipts against the shares held in custody. So basically, the shares which are issued, these are basically the depository receipts. These are the DRs. Like, we are talking about here the ADR and further about the GDR, or even these can be the IDRs. Getting it? So this is the whole point we are talking about. This is a whole point that's basically explained here. That's basically explained here, right? And after that, the next figure over here, it's related to the foreign investment here in India. So we are basically talking about the different terminologies over here. The first diagram which is given over here, it's related to the ADR, GDR, how it works. So Indian company will be placing its shares with the domestic custodian, and for the domestic custodian on behalf of the Indian company will be holding it, and further it will be having the agreement with the overseas depository, and the overseas depository is based upon the shares which are basically acknowledged by the domestic custodian, will be issuing the ADRs or JDRs, and there the overseas investor will be investing the money. So basically the money is invested into what? Basically the money is invested into the Indian company shares. Okay. And after that, it's about the foreign investments in India. So when we're talking about the foreign investment, we are having the multiple investment vehicles. Like, we are having the FDI, right? Now FDI is foreign direct investment, like investment which is made by the foreign entity directly into the listed or unlisted companies. So when it is listed company or unlisted company and the amount is invested into it, that's the FDI, foreign direct investment. Second thing, it's about the FVCI, that is a private equity. That's a private equity, or we can say foreign venture capital investor. Foreign venture capital investors, like the foreign investors investing in venture capital undertakings or startup companies in India. So in this case, the amount is invested into the startup companies, right? Into the startups, they are investing the money, right? And further into the capital undertakings, basically they are taking, right? Venture capitals they are having. So it's a FVCI. And the third one, it's about the FII, that is a foreign institutional investors, like the institutional investment in listed companies through the stock exchange. So these three things are through the stock exchange. This is through the stock exchange: FDI, FVCA, and FII. Okay, so that's about it. And other than that, it's related to the ADRs or GDRs, American Depository Receipts, or the Global Depository Receipts. And there can also be investment by the NRIs and PIOs, like the non-resident Indians who are residing outside India, the person of Indian origin, like foreign citizens having the Indian ancestry or origin. So they could be investing into the shares, they could be investing into the shares, they could be investing into the government securities, right? So whatsoever the FEMA allows, they are investing as per that. So that could be the scenario, that could be the scenario related to it. And other than that, it's related to the institutional investment in listed companies through the stock exchange, institutional investment. So when we're talking about the institutional investment, it covers only and only the FII. But when I'm talking about generally that through the stock exchange, who will be investing, there are three entities, right? So that's a part. So that's basically about the investment that we learned about so far, about the investment, that how the investment is being done. So it's through the FDI, FII, or FVCI. So this could be related to it. Getting it clear so far? And after that, the point is related to the capital budget. Now, what amount of capital budget is basically required, and that is determined by the company management. The company management will be deciding that what amount was required, that particular what amount was required. So capital budgeting is what in general, if you're talking about the capital budgeting, it is actually what it is basically the process of planning and evaluating. So when we are trying to plan, the planning and evaluating the expenditure on the fixed assets, right? So let's say if you are having a company and you know that for the long term you basically do need these expenses to be done, like in the machinery, in the building, etc. These expenses are to be made, so you'll be spending the amount over there. So capital budgeting is basically the process of planning and evaluating that how much amount is required for the fixed assets or for the long term projects. That's basically the capital budgeting is. That is a capital budget, right? Now the management basically determines the capital budget, like that could be for the expansion purposes, right? So that investment could be for the long term investments, or it could be related to that you want to set up the new project. It could be related to the you want to set up the new project, or let's say we want to purchase the machinery. So I've already told you. So basically we want the ultimate growth, we want to basically generate the returns, we want to increase the shareholder wealth, we want the business to be sustainable, right? Sustainable growth we want. So for those all purposes, we want to do the basically expansion, we want to invest the money into the long term assets. So that's the capital budgeting. We have to decide, we have to plan, because we are having limited resources, because we are having the limited resources. Getting it? And further, here we are to understand the international capital budgeting, because the international entity may also be facing the issues, because it's much more complex than the domestic capital budgeting, because foreign projects do involve additional risks. There are the additional risks, there are the work culture differences, there are the work cultural differences, like the different employee behavior. Let's say here is an Indian company, who has set up a branch there in USA. Now there are the work culture differences. There is a different legal system, different law, different taxation, different labor laws, compliance requirements. There is different currency system, right? And the different negotiation trade practices, like the different business traditions are there, and different accounting standards, trade barriers are different, local language is different. So there are so many differences. That's why there are so many issues which are basically faced while doing the international capital budgeting. Okay, while doing the international capital budgeting. And further, it's related to what? It's related to that we are to analyze some the things. The foreign investment analysis is to be done. The foreign investment analysis is to be done. So after that, let's have a look at the foreign investment analysis. The next topic, it's the foreign investment analysis. So here, first of all, it's about the exchange rate risk is there, as I just told you, because definitely there is the exchange rate risk. So exchange rate risk basically related to what? Now here in India you have the money in rupees, but there you are investing the money in USD, let's say. So definitely if the rupee weakens, or let's say when the USD appreciates, right now what's happening right now, right? So in that scenario, what will be happening? In that scenario, you have to invest more. You have to invest more. So particularly the for the cross currency transactions, the exchange rate risk is there. The second type, it's related to the transfer risk. Transfer risk, like it refers to the internal prices. Internal prices. So internal prices are basically different from the market prices. Like, let's say you are having one department, and from one department the goods are moving to the another department. When you're having the multinational enterprises over the multiple, let's say, countries you are established, when you're transferring the products from one country to another, there is an internal pricing is to be done, right? And further, the value of cost, the particular things could not be like correct. The correct relationship could not be there. And for that particular purpose, the particular capital budgeting analysis is to be done. So that's a transfer price. And the third one, it's a political or country risk. Now, definitely, if there is political instability, particularly, so there are the risks associated with it. One, it is related to country risk. When the you want to do the business, but the sanctions were imposed by the country, you won't be, that won't be into your control. And if there is political instability, that's also not in your control. Okay, so that's a part. Clear with it? Now let's have a look at the example. Let's just have a look at the example. So Indian companies basically, let's say, wants to do the investment, or they want to establish a manufacturing unit in the other country. They want to establish a manufacturing unit in the other country, or let's say they want to acquire some foreign company. So in that scenario, what are the different considerations? The first thing, it's related to the currency conversion. Currency conversion is to be done. That is a main part. That's basically the currency risk or the foreign exchange risk. So investments and returns must be converted between the currencies, and exchange rate basically becomes very much critical. Okay, so these are the what? These are the cross currency transactions. These are cross currency transactions when two foreign currencies are exchanged without direct involvement of domestic currency, right? So there are cross currency transactions also. Let's say you deal in INR, but we are dealing in GBP and USD. So there will be direct conversion of GBP to USD. So there is cross currency transactions also. So exchange risk is very prominent, right? That's there. And definitely the exchange rate volatility is there. There is a rate volatility. The prices are changing every single second. So currencies values may fluctuate sharply. So project cost and returns definitely can be changing substantially for that scenario. So that's another thing. And further, like for the foreign currency, transactions are affected. Like we have to do the import, export, borrowings, repayments, dividends are to be paid, right? Dividend remittance is to be done, profit repatriation is to be done. So if the rates are changing, if the exchange rates are altering, that will be altering everything. That will be affecting everything. Now, let's have a look at the classification of the investment projects. Let's have a look at the classification of the investment rates. The first classification is as per by the project size. Like the small projects basically approved by the departmental managers. Those can be approved by the departmental managers. But when there is a large project, it basically required a detailed analysis. In that scenario, in the case of the large projects, a detailed analysis is to be done and board approval is required, right? So let's say the projects above some threshold are to be approved by the board of directors. And the second classification is by the by the type of the benefit to the firm. The type of benefit to the firm. So let's say first one, it's related to increase in cash flow, like higher revenue or profit generation, or a decrease in risk could be there, or indirect benefit could be there, like for employee benefit, welfare, or for goodwill benefits could be there, right? And let's say the example we can say like we are providing the worker facilities, right? So that can be improving the productivity indirectly. So that's also the investment project. That's also the investment project. So that's by the type of the benefit to the firm. The third one is related to by the degree of dependence by the degree of dependence. Now, the one case it could be like the mutually exclusive projects could be there. The one case is related to the mutually exclusive projects. Like only one project can be selected. So either we are to choose project A or we are to choose project B, right? That's basically the case. And we also said to the opportunity cost. So let's say basically we have to select between the project A or B. So we selected the project B. So now the return of the A is a opportunity cost to us because we left that particular project because we could invest into one particular project only. The other type of projects, it could be the complementary projects. Like acceptance of one project increases the benefit of another project. So let's say if you are opening a warehouse, that may be increasing the sales of an existing distribution project. So that's the complementary project. And the third one by degree of dependence, it's the substitute project. Like acceptance of one project reduces the benefit of another. So one is going to complement the another project. That's a complementary project. And the another one is substitute project. Let's going to like decrease the benefit of the another. And the other could be the mutually exclusive project, like when it is like they're not basically accepted together, they cannot be accepted together, so that can be the scenario. Or the complementary projects could be there, or the substitute projects could be there. Further, the fourth type, it's related to by the degree of statistical independence. Statistical independence, now it could be the positive dependence, like cash flows move in same direction. Positive dependence, cash flows move in the same direction, that could be the by the statistical dependence, positive dependence. Or negative dependence, like cash flows move in opposite direction. When you're investing more, the money is more not there, not moving much. Or it could be the statistical independence, like there is no relationship between the projects. There is no relationship between the projects. So it could be the case that you are having the projects P1 and P2, and when the cash inflow increases in P1, it decreases in P2. That's basically the negative dependence. And when it increases in P1, increases in P2, decreases in P1, decreases in P2. So that's basically what, that's the positive dependence. And when they're not depending upon each other, that's basically what, that's the statistical independence. Okay. And further, the fifth type is basically by type of the cash flow. By type of the cash flow. So it could be the conventional cash flow. Like only one change in cash flow sign. Initial outflow, and further there after that there are inflows only. So if there is only one cash flow, only one change in the cash flow sign. So that's basically like you invested the money, that's a negative sign, and then you're getting the inflows only, right? Or it could be a case that basically there was a major inflow and there are the outflows only, right? So basically it could be one case like conventional cash flow. It could be the conventional cash flow, right? Or it could be the non-conventional cash flow, like multiple inflows or outflows could be there. So more than one change in the cash flow sign could be there. Okay, so this is related to the investment project, classification of the investment project. So when we are talking about the classification, when we are talking about the classification of the projects, so it could be by the project size. So let me write over here so that you memorize them. So one, it could be related to the project size. So it could be a small project, or it could be a large project, or it could be as per the benefit to the firm. Now the benefit could be in the form of like cash flows are increased, or risk is decreased, or the indirect benefits could be there. And the third one, basically the degree of dependence. Degree of dependence. Now, what does it mean? Like it could be the case like you are having the mutually exclusive projects, or we are having the substitute projects, or the complementary projects. And the fourth one, it was related to the by degree of statistical dependence. Now, third one, it was related to degree of dependence, and the fourth one, it was a statistical dependence. It's basically about the already existing projects. So it could be like all the projects are in one direction, or in opposite directions, or they are independent of each other, right? And the fifth one, it's related to by the way of type of cash, type of cash flow. Okay, so this is related to the classification of investment projects. classification of the investment projects, right? Now, after that, it's related to the foreign currency discount rates computations. Very important. This already we have read somewhat in the uh, BFM module A also, but this is important from the ABFM point also. So foreign currency discount rates computation. So one, it is related to the spot rate. Let me highlight the point so that you can just simply be memorizing this, right? Spot rate. Now spot rate is basically where the settlement is on T plus 2 days basis. T plus 2 days basis settlement is being done. So we are to convert the basically, or let's say we can say current exchange rate for the immediate transaction. So the settlement is on T plus 2 days basis, right? And the second one is related to the forward contract. Now forward contract is a derivative contract. The forward contract is a derivative contract and it is based on the spot rate. So it is forward contract is spot rate and further plus minus premium or discount. If it is at premium, we have to add it. If it is at discount, we have to reduce it, right? So that's the case. And what factors basically do affect the forward rate or the forward contract? What factors are there? So there are multiple things. One, it is related to the interest rate differential, the interest rate factor. Like let's say the interest rate in USA is 6% and let's say in India it is 12%. Okay, so in that case, you'll be investing into USA or India. Definitely, people will be investing where they are getting more returns, so they will be investing in India. So for that scenario, they are going to sell the foreign currency and they will be buying the INR so that they can be investing into the Indian economy. So that they can be investing into the Indian economy. So when there is more flow or more demand related to Indian rupees there, it will lead to rupee appreciation. It will lead to the rupee appreciation. So that's the interest rate definition. Other thing, it is basically related to like that affects the forward rate. That is the forward period. That is the forward period. Okay, so these are the factors which are going to affect. And other than the market, like demand and supply is definitely going to impact that. So after that, it's about the forward contract and the future contract. But like, what's the difference between these two? First of all, let's have a look at the meaning. So we have already covered that in the BFM in detail, but still we have to understand it from the ABFM point of view. So forward contract is basically the customized agreement for the future transaction. Let's say if you want to buy the or sell foreign currency after T plus 2 days, let's say after 15 days, 20 days, 1 month, 2 month, that's basically what that's a forward contract. That's a forward contract. And when we're talking about the future contract, it's a standardized, it's a standardized exchange trade contract. It's a standardized exchange trade contract. So basically, it is an OTC agreement, like the forward rate is OTC, and it is exchange traded contract, right? So these are standardized, and further these are tailor made. Like you can be deciding between, because it is between the two parties, so it's like you can be deciding for you what's better for you too. Okay, so it's tailor made, and further it is over the counter and it is exchange traded, and settlement date is basically on the maturity date, because you cannot be altering it. Whether the prices are good for you or not good for you, you have to basically go for those only prices only. For those only prices you have to basically select for. Let's say today price of the USD is 97.03. Okay, and after 3 months you book the price at 99.50. Let after 3 months you'll be getting the USD for 99.50. Now whether after 3 months, let's say price is 91 rupees, but still you can be getting the USD at the 99.50 and it will be obligation upon you. Okay, so that's about the forward contract. That's about the forward contract. But in case of the futures, there is daily settlement. There is daily settlement. It is basically MTM basis, marked to market basis. The futures are marked to market basis. So if we talk about the risk, there is a high counterparty risk. What risk is present in case of the forward contract? It's a counterparty risk, because two parties are directly dealing with each other. So counterparty risk is there. And if you are considering about the futures, there is low risk because the exchange is present. So default probability is higher in case of the OTC, but it's very lower in case of the futures. Okay, and if we talk about the size of contract, like the size of contract depends upon the terms, and size of contract is basically fixed because it's a standardized contract, and no collateral is required in case of the forward contract, and initial margin is required in case of the futures, because it is, as I already told you, it's on MTM basis, mark to market basis. And if we're talking about the maturity would be as per the terms of contract. And further, in case of futures, there is a predetermined date regulation. These are self-regulated, and the futures are regulated by the stock exchange. Now, these are basically, futures are present in the stock exchange. That's why these are very much liquid. Where there isn't, these are the bilateral contracts, so there is low liquidity, or very low liquidity, we can say. Clear with it? Clear with it so far? Do confirm that if you have understood the difference between the these two things. Kindly do let me know at the earliest so that we can move ahead toward the next topic. So the next topic, it's about the international portfolio investment and the institutional constraints. So it's about the international portfolio investment and the institutional constraints. Now, first of all, let's do understand the meaning of the international portfolio investment. Like, it means like the investment made in foreign financial securities. When you're investing the amount in foreign financial securities, right? Like in treasury bills or in mutual funds or listed equity shares, it could be, right? So you're basically invested into those things, but in foreign, you're going to invest that, right? So these do involve the cross-border remittances. There are the cross-border remittances. Foreign currency transactions are there. International financial markets you're investing the money into. And in India, there is a limit, and that's basically as per the LRS, that is liberalized remittance scheme. That limit is 250,000 USDs per financial year. Like being an individual, you can be remitting the amount up to USD 250,000 per financial year, and that's basically permitted to you for the current account transactions, and further for the capital account transactions. For the capital account transactions, this limit is permitted to you. Okay, so if you look at the features of the international portfolio investment, so first one it's related to there is cross-border transaction, like investment outside the home country is there. Okay, investment outside the home country is there. So this is basically the remittance of one currency, and further we are remitting it outside the country, and there is foreign currency involvement, and you can be investing into the treasury bills and the mutual funds, equities or ETFs, right? And further you get the global exposure. You get the global exposure because you are having the access to the international markets. So what are the benefits of the international portfolio investment? First thing, it's related to like developed and industrialized markets. They basically are the stable economies. So first thing we can say, the better investment opportunities. We get the better opportunity. Why better? Because the developed economies, those are much stable, right? Better growth opportunities are available over there. And the mature financial markets, those are okay. That's the first thing. And the second thing, it's related to there is availability of multiple products. There is variety of products which are available, like international mutual funds you are getting access to, country funds, ETFs, foreign stocks, right? And there is stability. There basically you feel safe, you feel lesser risk. Why? Because exchange rate stability is there, lower exchange rate volatility, and further your value is preserved, right? And your currency erosion risk is basically reduced. Okay, so that's the benefit related to it. And the another topic, it's about the diversification. It's about the diversification. Now you know diversification. Why? Because you can be investing the investment across the different countries. You're not like to invest into one single country. You can be investing into multiple countries. You can be investing into different industries. You can be investing into different asset classes. So that gives you a very good depth, a very good depth. So that's basically the main like benefit that you get when you're investing into international portfolios or investment into portfolio investment, right? International portfolio investment, IPI is there. So overall portfolio risk is definitely reduced. It's definitely reduced. You can be achieving the stable returns, better risk trade-off is there, better return trade-off is there, and the capital appreciation is there, right? So better risk return trade-off is there, and you depend lower side on the domestic market conditions. You're just not to depend upon the lower side of the market conditions. Like you're not dependent on only one domestic market. Okay. Now, what are the barriers? Now, we read about the benefits, but there are some barriers also, right? There could be some issues also. The first thing, it's about the political risk. There is basically the political risk. Like if the government is not stable, or there are some policy changes, or political stability is not there, that may be affecting your returns. So it's first thing about the political risk. Okay. Second thing, it's about the economic risk. Not economical, it's economic risk. And why economic risk is there? It could be basically the recession, inflation, or let's say fiscal instability, currency crisis, anything it could be there. So it's basically anything could be there, like inflation, recession, etc. And further, the language barrier, like communication and information gathering may become difficult. So it's about the language barrier. Okay, so these are the barriers which are there. The one, it is related to the political risk, the political instability, government risk, and policies might change. The second one, it is a economic risk like inflation, recession, fiscal instability, currency crisis could be there that may be impacting your investment. And also, like there could be some import restrictions that may be imposed, or let's say the government basically increase the import duty on something, or government basically put some restrictions upon something, or the exchange controls were put into, like, so that no more much money flows into the country. So there could be some restrictions related to it also. Those are said to be the price controls. So we can say another one factor related to it, that is basically the price controls. So these are the four barriers. These are the four barriers. One, it is related to the political risk, the other one, it is the economic risk and language barrier, and for the price controls could be there. Okay. Then after that, it's about the asset allocation. Asset allocation, like, means that we have to select the right combination. And what is the right combination that we have to select from? From the risk return combination. That what is the risk we want to take, and what is the return that we are getting, and for the in which particular assets we are to invest the money into. So there is a right mix of these three factors. One, it is a risk, how much return you want, and further in what assets you want to invest money. Okay. And there are different classes, like you are in the small cap stocks. There are small cap stocks, like, which give you high growth but high risk is there, or mid cap stocks could be there, like moderate growth is there, and large cap stocks are there. Like in case of large cap stocks, there is, those are stable, low risk is there. Or it could be like value stocks, or growth stocks, or treasury bonds, or rated bonds, right? Or debt securities, IPOs, FPOs, OFS. So you can have having the different investment classes. We are having the different investment classes. Then further, it's about the hedging strategies. Like hedging risk is basically like we want to safeguard ourselves. So what risk management technique that we have to apply? So hedging is generally the risk management technique that we are to use to offset the possible losses. So we are going to take an opposite position in the related asset, and that's going to hedge our overall exposure. That's hedging strategy. So our objective is to reduce what? Basically, we are to reduce the exchange risk. We are to reduce the uh, particular market risk and the price fluctuation. So that we are to basically take care of. Now, what actually happens? Let's say you purchased a car and you ensured it that even if theft is there, burglary is there, or something is there, you'll get the money back, right? So for that particular purpose, when you're getting the insurance, you pay some amount. That is basically the premium that you pay. And when we do pay some premium, our overall profit is somewhat reduced. If something happens, or never even happens, you have to still pay the premium. That's not refundable. That's not refundable. So cost of hedging basically involves that you have to basically pay the premium we are to pay the premium. There is transaction cost included into it. There is transaction cost included in it, and that will definitely be reducing our potential profit. Definitely, we get a promise that definite overall risk is like lowered one, but at the cost of our profits. That's a cost of hedging. And there are different instruments which are used for hedging purposes. Like it involves derivatives such as few forwards, options, futures, contracts, right? So these are basically the different instruments which are used for the hedging purpose. Like in the case of the forward contracts, we lock future exchange rate. For future contract, these are the standardized hedge contracts, the future contracts. And when we're talking about the options, these give you right without any obligation, or even the swaps are there, like the interest swap is there, interest rate swap is there, right? So that's related to exchange of the cash flows. Okay. Now, after that, it's about the direct and indirect channels for the international portfolio investment. Direct channel is like when the investment is directly into the foreign securities, direct directly into the foreign securities. Like if the ADR of company, let's say Cisco is listed, Cisco company's ADR is listed, and you invested the amount into being an Indian that's listed on the Indian Stock Exchange, and you invested into this ADR, right? That's a direct investment into foreign security, right? So it could be related to the ADRs, it could be related to the GDRs, it could be related to the exchange traded funds or the multinational corporations, right? So that's a direct channel. That's the direct channel. So it could be the direct channel, it could be the direct channel, or it could be the indirect channel. Indirect channel means when you're investing through the intermediary. Like you invested the money into the mutual fund, and mutual fund in turn is going to invest into the foreign sectors. That's an indirect investment. Further, I've already given you idea related to the exchange risk, like the risk which is arising due to the fluctuation of the currency. Fluctuation of the currency. It could be due to inflation. It could be due to the fiscal policies. It could be due to the sanctions. It could be due to the pandemic, economic instability. It could be anything. So one, it is related to the exchange risk, and the other one, it's related to the country risk. When the sanctions are imposed, when the political instability is there, when the trade restrictions are there, revolt is there, elections are going on. So that's a country risk. That's a country risk. Then it's related to the return and risk of foreign investment. Return and risk. So when you're having the high liquid investment, so it depends upon what? It depends upon the liquidity. It depends upon the growth, long term, right? It depends on the multiple factors. So there are key principles related to it. One, it is related to the liquidity. One, it is related to liquidity. So if we say the liquidity is higher, if we say the higher liquidity is there, now that will going to increase the returns or lower the returns. So we can say the lesser or lower returns will be there when the liquidity is higher, right? And when you are having the illiquid investment, the returns will be higher. So the point is, more is a risk, more is a return. Higher is a risk, higher is a return. Secured investment is there, low return will be there. Strong currency country, better returns will be there, right? So that's the point. So these are the points related to it. Further, it's related to the dividend reinvestment or dividend accumulation. So reinvestment plans basically do provide you with higher returns or lower returns. They provide us with the higher returns. The dividend reinvestment plan do provide us with the higher returns. What is meant by the dividend accumulation or dividend reinvestment? Let's say we invested rupees 10 lakh, right? And we got dividend of rupees 50,000. Now, instead, we are going to repatriate this dividend. We'll be surplusing our total investment. Now we invested total amount 10 lakh 50,000 next year, right? After getting the dividend. And definitely when more amount is invested, more returns will be getting. So higher compounded returns are there. Okay. Further, after that, it's about the CAPM. Very important. Very important. We can write over here too. That's important topic. CAPM is what? It is capital asset pricing model. It is a capital asset pricing model. So it's going to establish the relationship between the two things, like between the risk and the expected return. So it's a relationship between the risk and the returns. The CAPM model, capital asset pricing model, right? So it's going to measure at how much return the investor should be expecting for taking any of the systematic risk, right? So expected return and the systematic risk, what should be the like relationship between those particular two things? That's the CAPM. So it's going to measure how much return being an investor should be expecting for taking the particular risk. So it's basically the analysis. It's the analysis used for what? Used for pricing of a particular security, right? And what is the formula related to it? The formula is quite simple. It is RE is equal to RF plus beta 1 and RM minus RF. This is the formula. Now, RE is actually the cost of equity. RE is what? It is a cost of equity. Let me write over the things over here. It's the cost of equity. RF is what? This is risk-free rate. It's the risk-free rate. And beta is basically representing the systematic risk. It's itself representing the systematic risk. And RM is expected market rate. And RF is the same thing, risk-free rate. Already told you, right? So these are the different factors. R is a cost of equity. RF is a risk-free rate. Beta is a systematic risk. RM is the market risk premium. And this term particularly, RM minus RF, this is representing what? This is representing the market risk premium. This is actually representing the market risk premium. That what premium the market is paying you, okay, for trading of this systematic risk. So risk-free rate is basically like the return on the risk-free securities. So let's say you're getting some return on the government treasury bills. So those are risk-free. Those are risk-free, right? So what's the return over that you're getting? That's a RF. And market risk premium, that is RM minus RF, that's basically the extra return. Because we are taking some risk. So over the risk-free return, what return we are expecting? That's a premium that we are getting. Okay. And beta is basically what? That's basically the volatility of the stock. When we are comparing our stock movement as to the index movement or index movement, that's a beta, right? So let's say if your beta is greater than 1, if beta is greater than 1, it means the security that we are investing into, it's carrying more risk than the average market risk. So let's say the Sensex is moving, the Sensex moved 1200 points, right? But your own share moved, let's say percentage wise, we can compare. Let's say the Sensex moved 1.2%, right? But your share moved 3%. Now, what does that indicate? That indicates that there was more movement in the share that we invested than the movement in the index, right? So that's represented by beta, but it's basically talking about the risk rather than the returns. So if beta is greater than 1, it means higher risk than the market. Higher risk than the market is there. If lesser than 1, lower risk than the market. If beta is equal to 1, same risk as the market. Okay. So it's the formula that we have learned so far. The cost of equity, RF into RF plus beta 1 plus RM minus RF. RF is a risk-free return. Beta 1 is a levered beta. RM is a expected return. RM minus RF is a market risk premium. I've already told you about the different components of it: risk-free return, market risk premium, and the beta. Clear with it? So beta can either be, let me write over here, right? So that you can memorize. So beta is equal to 1, or beta is greater than 1, or beta is lesser than 1. So what I just told you, beta greater than 1 means what? Higher risk or lower risk? It's higher risk. Beta greater than 1, higher risk. Beta lesser than 1 means lower risk. And beta equal to 1, same risk. Same risk as that of the market. Getting it? And even one can be asking you the formula related to the beta, but we are not to go into that much depth, right? So that's about the CAPM. That's about the CAPM. Clear so far? Do confirm at the earliest so that we can proceed. Okay. So let's move further now toward the next topic. It's about the arbitrage pricing theory. The next one, it's about the arbitrage pricing theory. So arbitrage pricing theory, we say it to be APT. It's APT. Now it's an alternative. Alternative to what? Alternative to the CAPM method. It's basically an alternative to the CAPM, that is capital asset pricing model. And basically APT assumes, and what does it assume? It assumes that return on security is basically dependent upon the macroeconomic factors like GDP growth, inflation, gold prices, or what, right? So whatsoever the return, so when I'm talking about the return, that's dependent upon what? That's dependent upon the macroeconomic factors. That's the first point it says. The second thing it says, the security prices. The first thing it's related to return. The second thing it's about the security prices. And those are influenced by what? Those are influenced by the systemic risk. So security prices are influenced by the systemic risk, right? And systemic risk will be arising from what? It will be arising from the economic variables. So these are the two assumptions in case of the APT. In case of the APT, arbitrage pricing theory. So first thing, it assumes that return on the asset is depending on the macroeconomic factors. So there are multiple macroeconomic factors like the gold prices, interest rate, inflation, GDP, etc., etc. And the second thing, the security prices, those are basically dependent upon what? Those are dependent upon the systemic risks. Okay, so these are the two assumptions which are made by the APT. So let me highlight this. So first one, it's about the assets expected return. And further, the second thing, it's about the security prices. So what is the formula of APT? What is the formula of APT? It's RF, risk-free return, plus beta 1, RP1, plus beta 2, RP2, plus so on, up to beta n, RPN. Now, this is related to the expected return in case of APT. Now, ER is representing the expected return, RF is the risk-free rate, and beta is sensitivity to factor, and RP is the risk premium. RP is, this is a risk premium. Okay. Now, here we are provided with one question. It says that if the following four factors have been identified as explaining stock's return and its sensitivity to each factor, and the risk premium associated with each factor has been calculated. RP is the risk premium, and gross domestic product growth. Like I told you, these are the macroeconomic factors. I already told you that these are the macroeconomic factors. The one it is the GDP growth, other one is inflation rate, gold prices, census index return. These are given to us. Okay. And beta for these are given separately. Beta is given to us. And the risk-free return is given to be 3%. So here we are provided with RF. And here we are provided with beta 1, beta 2. So let's consider for this, it is as the beta 1, and this one as the beta 2, this one as the beta 3, and this one as the beta 4, right? And also the risk premium is given RP1, RP2, RP3, and RP4. That is given. So we can simply be calculating. So it will be like 3%. It will be like 3% or 3 plus, for the first term it will be 0.6 into 4. So it is 2.4 plus, for the second one it will be 0.8 into 2, that is 1.6, plus minus 0.7 multiplied by 5, that is minus 3.5, plus the fourth one, that is 1.3 into 0 into 9, that is 11.7 something. Okay, so we can easily be calculating this all, and through which we calculated, and it came out to be 15.2%. So this is the expected return. This is the expected return using the APT method. So APT basically does consider the multiple macroeconomic variables. It is much more realistic than the CAPM, and definitely it is used for the diversified portfolio. But sometimes we are not too able to identify the macroeconomic factors, and the complex basically calculations are present over there. Okay, clear with it? Kindly do confirm. Right. Then it's related to the international capital budgeting. It's about the international capital budgeting. Like international capital budgeting means that we have to evaluate the project's investment, but which are overseas, right? So we are to basically establish a project there, and for that particular purpose, we are to evaluate that what capital decision is to be taken. Like if you want to go for the foreign manufacturing units, overseas branches, international expansion or something. So that's about it. That's the main purpose related to it. And what are the reasons for the foreign projects? Like it could be like we want to tap the foreign market first of all. Definitely you want to expand your functions, you want to tap the foreign market. So as to tap the foreign market, we want to sell the products abroad, or let's say we are to get the excess of raw materials from there. We are to use foreign resources, right? Or we are to take the cost advantage. It could be the case that we are getting the material like at a lower cost. We want to like capture the global market, we want to capture the international market. So these are the reasons that we want to go for the international projects, and the decisions which are to be taken, that is set to the capital budgeting. So first thing, it's about the project evaluation, that we want to check the feasibility of the project. So when we're talking about the project evaluation, we are to check whether the particular project is feasible, is it viable or not. We are to check the profitability of it, profitability of the project. We have to check that what risk is present there, right? And is this project sustainable? Is this project sustainable? So before implementing the project, we have to evaluate the things. We have to evaluate the things beforehand. Like we cannot be doing it after the project has been undertaken. We have to do it before the project is implemented. And what are the objectives of it? Like we want to assess the profitability. Why we want to do the project evaluation? Why? We want to assess the profitability, right? We want to measure the risk. We want to improve the overall efficiency. We want to be like We want to aid our decision, like whether we are to select the project or not. And what are the issues of evaluating the project overseas? First thing, it's about calculating the discount rate. Now, if you know discount rate, we have basically talked about it in the previous chapter also, like at which the future cash flows are to be discounted. So whether we are using the NPV method, net present value method, or internal rate of return method, right? Or any discounted cash flow method, which we say to be DCF method. So for we are to discount the, we are to basically assume the, we have to calculate the discount rate, and that could be like a difficult thing for us. That could be a difficult thing. So arriving at an appropriate discount rate is very much essential, very much required. And it may be the case that we are not able to do that, right? So that particular risk-free rate is readily available. Like we just checked that in what particular government security you're getting what return. So that's a risk-free return that will be getting the idea. But so as to arrive at the relevant risk-adjusted discount rate, it's difficult. It's complex because we are to arrive at this risk-adjusted discount rate for both of the countries, for the India and also for the foreign country. So we are to calculate the risk-free return for both in India and the foreign country, and we are to calculate the discount rate for India and for the foreign country. Okay, getting the idea. And what is the formula for risk adjusted discount rate? This is the formula. This is the formula related to the risk adjusted discount rate, risk adjusted discount rate. That is 1 plus RA is equal to 1 plus RF, 1 plus RP. RA is risk adjusted rate, RF is the risk free rate, and RP is the risk premium. So this is the formula. Okay. So the risk free discount rate in US is given to be 4%. In India, it is given to be 7%. The risk adjusted discount rate required by the company in India is 12%. So you're provided with the 12% India risk adjusted rate. So how we'll be calculating? So it is a RA we are to calculate. It is RA that we are to calculate. So we have to calculate the risk premium first of all. We have to calculate the risk premium first of all. So how we can be calculating? So it will be 1 plus RA divided by 1 plus RP. So from this formula, we can be simply be calculating like RA, risk adjusted rate, is RA. Okay. Now what it is given to be? Any idea how we are going to calculate for this particular case? How we are going to calculate? It is 1 plus RP. If we are to calculate the, first of all, the first step, it's related to, we are to calculate the, like applying the formula for the rupee discount rate so as to calculate the risk premium. Because for India, you are provided with the risk-free rate RF India, and further, you are also provided with the risk-adjusted discount rate RA in India. RA in India. So you'll be calculating the risk premium, right? So RP we can be calculating for the from this particular formula. So this will be 1 plus RA, that's 12%. So it is 1 plus 0.12, that is 1.12. 1.12 is equal to 1.07, and further multiplied it with the 1 plus RP. So from here we can easily be calculating, and it came out to be 1.0467. So we can be calculating it like RP came out to be what? It came out to be 4.67% if we calculate it in percentage here. Because this is for 1 plus RP, we got the value 1.0467. So RP would be equal to 0.0467, and converting it to the percentage, so it will be 4.67%. And from there on, we have to calculate further. From there on, we have to calculate further. like the risk adjusted rate for the US, because now we are having the RP with us. RP is already available with us now, and from there we calculate the RA, and that came out to be 8.88%. From here it came out to be 8.88%. Right? Understood this particular point? So we are to memorize this particular formula, that is a risk adjusted rate. This formula is related to the risk adjusted rate. So it is 1 plus RA is equal to 1 plus RF multiplied by 1 plus RP. So this is the formula that we have to use, right? After that, it's related to the estimating exchange rate in future years. Estimating the exchange rate in future years of the project's life. So what is the main need? Like, the point is, let's say you are having this timeline. This is a timeline we are having of the project. 0, 1, 2, 3, 4, and you invested, let's say 10 lakh USD in this particular project. Now, after 1 year, you'll be having the cash inflows. After second year, third year, fourth year, you'll be having the cash inflows. You'll be having the cash inflows, right? Now, when you're having the cash inflows after the multiple years, but today price of USD is 97 rupees. So now what we have to do? We have to estimate that what this exchange rate would be there. So this is very much essential. This becomes very much essential before discounting, right? Before discounting, we have to calculate what is the current spot rate. We have to calculate what is a current spot rate. That is essential. So that's what we are talking about. So here is a example. The following data is given. The notional risk-free rate in USA, it is 4%, like RF in USA, and risk-free rate here in India, it is 7%. Current spot rate is given to be 80 rupees. And we have to calculate the estimated spot rate at the end of each of the years of the project life. At the end of the each of year, we have to calculate the spot rate. We have to basically calculate the spot rate, or we can say we have to calculate the estimated spot rate. And there are the multiple approaches for it. There are the multiple approaches for it. Like the one, it is related to the HCA. The approach we are talking about, it's a HCA, or it's a FCA, or it's a FCA. It's a foreign currency approach. The first approach that we are going to talk about, it's the HCA. That's the home currency approach. It's a home currency approach. Like foreign currency cash flows, whatsoever the cash flow is there. So the steps are followed, like the cash flows are converted into the home currency. Whatsoever the cash flow is there, that's converted into the home currency. And after that, those are discounted. The discounting is done thereafter. That's a home currency approach. So first of all, we do estimate the future foreign currency inflows. Cash flows are estimated, and then we'll be converting them into the home currency. And after that, we are going to discount those values so as to calculate the present value. Getting it? This is a home currency approach. This is a home currency approach, HCA. And what's there in the case of the FCA, foreign currency approach? In case of the foreign currency approach, the process would be like that we are to estimate the cash flows, and now we are keeping the cash flows in foreign currency only. And then we'll be simply be discounting it in the foreign currency. Discounting will be done, right? No conversion to home currency, first of all. And we calculated the present value, and then we'll be converting into the home currency. That these steps are being followed. These steps are being followed in case of the FCA. Okay. So first of all, we have to look into the home currency approach. First of all, we have to look into the home currency approach. Here, the amount is basically estimated. The cash flows are basically estimated, and those are converted into the home currency first of all, right? So we have to basically apply the estimated spot rate of that particular time, and we'll be converting that particular cash flow into the home currency, and then we'll be discounting it. And further, for that particular purpose, we have to use the domestic risk adjusted discount rate. We have to use a domestic risk adjusted discount rate. So here is the question. Initial investment is given to be 100. First year cash flow 30, second year 40, third year 50, fourth year 50. Risk adjusted rupee discount rate required by the company, risk adjusted rupee rate, right? That's basically in USA, the RA, which is basically required, the RA in USA, which is required, is 12%. That is given to be 12% over here, right? And the notional risk-free interest rate in USA is 4%. Basically, what is given? The notional risk-free interest rate in USA. It means RF in USA is given. Notional risk-free interest rate in India is given. Risk-free RF in India is given. And the current spot rate is given. We have to calculate the PV of the cash inflows of the project, which has a useful life of 4 years using the home currency approach. Using the home currency approach, we are to calculate. Now, how it will be done? Any idea how we are going to solve it? Kindly do solve it at the list so that we can proceed. So I just told you about the formula, one particular formula that we have to use in this case. That's basically 1 plus RA is equal to 1 plus RF and further multiplied by 1 plus RP. This is the formula that we have to use, right? But we have to calculate the forward exchange rate using the IRP. We are to use IRP. Now, what is IRP? It is a interest rate parity. It is a interest rate parity, and the formula is very simple. It is F is equal to S multiplied by 1 plus RH or RF in India, and further divided by 1 plus RF in USA. 1 plus RF in USA, we can say. Like this is represented by this. Now here the spot rate, S is basically the spot rate. S is given to be 80, right? This is 80. And for the 1 plus RF India, the risk-free return in India, it's given to be 7%. So it is 0.07. And for the divided by the risk-free return there, the risk-free return there in USA, it is 4%. So it is 1 plus 0.04. Now calculating it using the simple calculator. So it is 1.07 divided by 1.04 multiplied by 80. That is 82.31. It came out to be 82.31 per USD. This is the year one forward rate. This is a year one forward rate. Why? Because here I just never basically showcased you one term that's raised to power n. Here it will be n. Now for first year, this is equal to 1. This is a spot rate, estimated spot rate after 1 year. And the same way you can be calculating the spot rate after second year. And how it will be done? Like it is 80 into 1.07 divided by 1.04 raised to power 2. That's it. That's it. You can easily be calculating it. For the first year, second year, third year, fourth year, we can easily be calculating the forward rate. Right? So that's the point that we have to follow. That's the point that we have to follow. Okay. So this is the approach that we have to follow in the questions. And after that, it's about the foreign currency approach, but that will be covering in the next video. So I hope that you must have liked the content. So if you like the content, make sure to rate this video out of 10. And do not forget to like this video and further share this video with your friends. And if you want the complete course, simply just do write CAIIB. The complete crash course for the CAIIB is available. In English only language is also available and in bilingual also available. And WhatsApp it to the number 83609 and I'll be sharing all the details with you. Right? So that will be all. Thank you so much and see you again in the next video.